Now we're back on track. So most people ask these for these documents, but they really don't. They get them, they look at them, they put them in a folder, and never really look at them again. And they don't really mesh them together and follow the paper trail, their money trail, all the way through the end, and ask themselves the right questions of what is the financial story of this property, because that's what you need in order to build your business plan, build a sound pro forma. You need it for being able to attract capital, to get investors on board. You need to know exactly how this property is performing and be able to relay that to them. And then also your debt partners as well, the lenders, you need to be able to show them that this property is going to meet their requirements, either DSCR requirements or whatever. So this is the process that I do whenever I'm doing my financial due diligence. So I request these main documents. So it's going to be 1, 2, 3, 4, 5, 6. So they estoppel agreements. If you don't know what that is, that's going to be a form that the tenant or resident signs, says that has the amount on there, the lease amount, and it says this is the amount that I agreed to pay when I get there. And that it's pretty much a form that like prevents landlords or people from like doctoring leases up. Okay, so it's a form that the tenant signs at the sale or close to sale during this process of due diligence. When you're under contract, it says yes, my rent is $700 and I agreed to pay $700. That is the correct amount. So you take that. The next document is your lease agreements. Okay, you get all the leases from the seller, and you get those, put those in a folder. You get the rent roll. The rent roll is going to be the leases, pretty much all on one page. The dates, the start date, end date. It's going to have, sometimes they have their security deposit amounts on there. Sometimes it says if they're current or not on there, if they have any balances due, but the basic rent roll. Okay, that way you can add up and figure out what your monthly gross scheduled rent is. Okay, and then next one is going to be the bank statements. A lot of people don't ask for because they think it's like not appropriate to ask for, but I absolutely ask for the bank statements. I want the last year of bank statements, as well as the profit and loss statements, or another name, the T12. So T12, profit loss, interchangeable, right? And I want those. And then lastly, the tax returns. Again, a lot of people don't think that it's appropriate to ask for tax returns. We absolutely ask for them, and I've never been denied access to them if I put it in my purchase contract. And that whatever sub block where it's like other stuff that you're requesting, I put all this stuff in there. Okay, so once I have it, the process that I do is now we enlist the help of some data entry people to help us plug all this into a spreadsheet. All these documents, all this stuff gets plugged into a spreadsheet, and I follow the dollars from the estoppel agreements to make sure the estoppels match the leases. I make sure the leases match the rent roll. I make sure that the rent roll matches the P&L top line, and I make sure that the bottom line of the rent roll, or the P&L, either the NOI or the owner distribution, matches what's in the bank statement. And then I go to the tax returns and I make sure that the tax returns match the bank statements. So what you're gonna find normally is the leases don't, common things you find is the leases don't add up to the rent roll. And then the P&L doesn't add up to the bank statements. So the P&L might say they have an NOI of whatever, 10 grand. And then you get the bank statements and there's only, $5,000 getting deposited every month. Okay. They could have a perfectly good explanation of why that is. But I'm going to ask and hopefully they tell me, because that's going to be a standstill for me. Obviously losing that much NOI on paper is going to severely damage that pro forma, that assumption I had for that deal. So I want to make sure that the profit and loss statement matches what the bank statement are. That's critical. And then again, the bank statements match the taxes as well. So I follow this. I go through, I use Excel a lot, and I take all these documents and I plug them into Excel sheets, and I can easily track. You can do things like conditional formatting or pivot tables to make it really simple to follow those breadcrumbs all the way from the paper that the tenant side said, yes, my rent is $700, all the way to the tax return. And it's absolutely critical that you do this as part of your financial due diligence, because there are some shady people. I haven't really seen it as much in the deals I've done, that either doctor leases or the rent roll is so much higher than it is in reality. But we have seen a couple grand. And that's a lot of the times they just, I don't know, bad data entry or just not keeping up with leases. And they just keep renewing them or something like that. But I haven't seen anything that's like fraudulent. It's usually just really, really bad bookkeeping. But if they said something on their pro forma, on the broker's pro forma, the seller's pro forma, that said this property was operating, in this, way, and that's what they're selling it on. And then you go through this process and you realize now the NOI is actually like 30 grand less than what you said it was. Now you have very legitimate black and white fact driven reason to renegotiate on a deal. And how are they going to disprove you? They gave you the information and you just analyzed it. All right. Is there any questions on that of going through the process of getting these documents or why they're all critical and going through the process of analyzing through them? Great. Okay. So let's go to the next slide. So as you're doing this, there it is. So we have some vector checks that we have in here. I just threw a couple questions on here that I'm constantly asking myself as I'm going through this process is, do the numbers add up? Which, you go through the estoppels, and if all the estoppels say I have, my gross rent's $10,000 a month, but then they're showing me a rent roll of, $15,000 a month, we have an issue, right? That's going to be a huge red flag. Everything stops until I figure out that issue. All right. And the next question is going to be, do they support your assumptions? So usually when you write an LOI in a deal, you've done some kind of initial analysis, some kind of, spreadsheet or back of the napkin calculation or whatever you have that at least lets you know it's good enough of a deal to at least throw an LOI on it. And you start building, your loose business plan and everything like that, and your financial modeling. And then as you're going through this, you want to say, okay, am I getting better or worse here? Usually it's worse. Usually as you go through this process, you're going to have to go back to your assumptions and be like, okay, it's not the same story as it was, a week ago. Write down why, write down specific instances where the leases didn't add up or the profit and loss doesn't match the bank statements. Again, that's a huge one that a lot of people just don't do. They don't, because again, they think it's, inappropriate to ask for bank statements. So they just don't ever ask. And they think that the number on the bottom of the profit loss, that's what they're actually getting. But then you get the bank statements, you're like, wait, where'd the $5,000 go? Right. So that's a huge red flag. So you go from there, and then once, do they support your assumptions? Now do you actually have to adjust your pro forma? And this is where you're actually going in, building out the rest of your financial model to figure out, are you still hitting your KPIs? And we talked about KPIs, I think last month or the month before, those things like the equity multiple you need to hit, your IRR, your AAR, your, what else? Equity multiple, IRR, AAR, ROI, all those KPIs that, you set in place to make sure that this is a deal that I'm going to go after. So do you need to adjust your pro forma, and do you still hit those KPIs? And if you don't, then you have to, go back and either back out of the deal if it's so far off that you're not even, playing in the same game anymore. You're not even in the same class of property anymore, or whatever the situation is. It might just be make sense to back out. Or you can go back and renegotiate and with the facts that you found. And when we've done it a few times. We've never had a broker or a seller get insulted at us, like, oh my God, like how dare you? I'm like, look, this is just a spreadsheet, and all of this red cells all over it is all the numbers that didn't add up from my financial due diligence from the story that you originally told me. And like, how are they going to get mad at that? So it's just showing them that they have really bad bookkeeping. So when I did that, when we do that, we always go back, renegotiate. Again, never really had a hard time if there was an issue. I will say that there is some instances where you might find an opportunity that their bad bookkeeping goes in your favor. And it usually happens in the security deposits. So if they have really bad leasing agents or bookkeeping or something like that, the title company is going to give you the credit for security deposits based off of the security deposit report or based off the rent roll. Okay. So they might have security deposits still on there for like tenants that moved out. So they're like, they can add up all the security deposits, and there might be $5,000 security deposits that they're holding. But then you look at the estoppels, and they might only have, or the leases, and they only active leases, and they only have like $3,000 in active leases. So that might be, something where you might make out on top. And that'll be up to you if you want to bring that up to them and give them their $2,000 back. Because otherwise, the title company is going to give you a credit on the settlement statement for that amount, even though the sellers don't actually have it. So that you can just put in your back pocket if you want to use that or not. And then remember with this one, you're not going to just follow the checklist. A lot of people, when they're newer, again, they have the checklist, which is amazing that they're using a checklist and they're following, something that kind of got them through the financial due diligence process. But don't just check the box. Don't say, okay, my checklist says I need leases. And then you get the leases and you put them in a folder and you don't even look at them, or the rent roll or whatever it is, or the estoppel agreements, or like actually look at this stuff. We have our intern now, paid intern. So whatever that is, employee or our guy, he's doing data entry for us. So we gave him all these documents. He's really good at Excel. He threw them up there in a couple of hours and made this awesome system for us where we can quickly cross-check these numbers, go forwards, backwards, and make sure that we understand the full financial story of this property. So I highly recommend that as well, just to help take that data entry load off your plate, so you can focus on higher things. Have somebody do the data entry, and then you just come in after and make sure that it's the story adds up, and don't just check the box. So that's all I have for my bit this month. We're trying to make them shorter because I am very long-winded. So if there's any questions on this financial due diligence, we can talk after, maybe in the breakouts or whatever, but I think we're good to press stuff. Now that the boot capital. All right. That was fun.
Holy smokes. And look at that, you guys. Oh my, the leasing has been outstanding. We finally broke the 90% occupancy barrier. That's why we got some celebratory little streamers and stuff there. So currently 91.7% occupied. So we're internally going, woohoo. And if you're one of our investors, you should be too. So latest updates for the leases signed a year to date. Last couple of months, since we didn't do the update for last month, we had 3 for August, and then already 3 for September. You guys, it's only the 8th. So yeah, Zach's cranking them out down there. And how many do we have under progress right now, Vince?
4.
Yeah. So just, and he's getting them leased up pretty much
before the paint dries. We're not even, our marketing budget hasn't even been touched because he just has so much organic traffic that he's just leasing them up. So it's pretty awesome.
Yep.
The reason that, 91 normally doesn't sound that great, but when we bought this, we were well into the 70s when we closed April 15th in the middle of COVID. So when me and Duke went back and redid our assumptions for this project, we put it in our pro forma that we weren't going to hit 91, which is for this market essentially stabilizes 91, 92, well into the second year of this reposition. And Zach was able to do it in like 4 months. So that's why we have the little cone and confetti there. So good stuff. All right, CapEx in progress. So we have 4 vacant units, I believe at this time. So maybe not 6 that are, we have 4 under renovation right now. The stairs, we went back on that one and he evaluated those a little bit more. And we have a couple bids for them to get those redone. We had already painted the stairs, the handrails and everything like that. But the actual stair itself, we were going to replace. And after looking closer, they are not in as bad condition as we originally thought. So there's going to be a couple that we go in and swap out the individual steps. But for the most part, there's not an immediate, crisis to replace those steps. So we're going to take that project and push it down the timeline a little bit, and actually move up the unit conversion project. And we're really excited about that. So we actually there's an office project. There's an office space, the leasing office, and there was some kind of like back room. It was like the handyman's room, and it was like 1,300 square feet of unutilized, not revenue generating space on this property. Matt just got a contractor to go and do some blueprints to turn that office space into two. I think is that what we went with, the 2 option, or we're going to get one for both, one for 1 unit, one for 2 unit? I don't remember.
He's playing with his chicken.
Sorry. Yep. My fingers were wet. My mouse wasn't working. Yeah, he's going to give us 2 options to choose from, 2 unit or 1 unit. Yeah,
so we're going to take that leasing office, and he's going to carve it up and some blueprints, and then we're going to make the decision to either do like probably 2 1-bedrooms or 1 2-bedroom, and turn that unutilized space into some cash revenue generating units, and that's going to be great. And then so we move the stairs down, push the unit conversion up into Q3. So we're in Q3 right now. So they're going to be starting that project, this month and going into Q4. Water conservation is pretty much done. That way, again, if you don't remember what that was, it was putting the low flow aerators in the faucets, low flow shower heads, low flow, replacing all of the toilet valves because the seals go bad in those, and there's just a lot of water waste that you end up paying for. But then also converting it to not just refreshing the seals on it, but a lower flow toilet valve and float as well. Usually when we do a water conversion, we normally see like a 20 to 30% drop in water conservation if the property's like hasn't been taken care of. Because most of the time when we're taking on a product like this, like a 70s, 80s, like nobody has ever changed shutoff valves. Nobody has ever changed the toilet valves. So they just have like water just leaking in almost every unit. So just stopping the leaks will drop that water bill significantly, and then add a rub on top of that and actually recapture some of that makes a huge jump in your NOI. So doesn't sound fun or exciting, but I love the water conservation bit. And then the picnic area we bought, there's the old pool, and we got that cemented in. Got 2 of those park style barbecue grills, putting those down, getting some picnic tables, and turning the old pool that was cemented in at some point, or covered at some point, and then we got it cemented over, and we're going to turn that into a barbecue area. And that's going to be a two-fold thing. One, we offer a good amenity for the residents, and 2, now we can enforce the no barbecues in front of your door a little better, because when we came in, there's a lot of residents that had like the little Weber kettles out in front of their door, and I don't really have an issue with that. People like to barbecue, but there's two things, right? One, it doesn't make the property look that good if there's just a bunch of clutter outside people's doors, and 2, there's the obvious insurance issue of having a fire right within 10 feet of the building, 10, 15 feet of the building. So the insurance company wasn't too keen on it as well. So rather than coming in being the bad bosses or bad new owners and be like, oh, get your crap out of here, now we're going to offer them a new place to hang out, barbecue, away from, a nice safe place, nice clean, fresh amenity. And then with that, we'll say, okay, now we offered you this. Now we're going to also start enforcing the no barbecues in front of your doors. So things like that to think about. And that is it for CapEx that I can think of. Matt, you got anything significant?
No, I did not. That covers
it.
Yeah,
there's one.
Yeah, so just the completed items, the new washer dryer. That's really the biggest project that was done recently.
So these are, go back to the washer and dryer. So these are leased, and they are both coin operated and card operated. So they accept all major credit cards, which is going to be a huge value add for the residents. They don't have to go get a bunch of change and quarters. Every time they need to do laundry, they can use their cards. And we got a pretty decent split on that contract too.
That's what I was going to say is I think standard is like 60-40, right?
Yeah, 60-40, 50-50. Our other one's 50-50. So.
Yeah, what do we end up on this one? I thought this one was like 55.
65. Yeah, 65-35, I thought.
Yeah, so they came in and they bought our old ones for more than they were worth. I think they gave us $1,600 for them, and then put these in for free service and maintenance, and then we just split the profits.
Yep. It's really good. Some new signage, mainly that the property protected on 24-hour surveillance. We threw that up. I'm probably in the next year, maybe next spring, going into Q1, we're probably going to reface the side of this building, make it look a lot more attractive. There's another property close by here. Its name is La Cima. And what they did to their office, their leasing office, made it look kind of hip and everything like that with those, what do they do? Like the wood planks,
like cedar planks. Yeah.
Yeah. The cedar planks, or how people like the distressed wood, like think like if Johanna Gaines was going to redo the side of a building, it was like that reclaimed wood look on the side, and it looked really cool, really catchy. And what is it?
I said like an accent wall.
Yeah, but on the outside, and it looked really cool. So we're probably gonna do something like that just to make this wall pop a little bit more inviting. Right now, we're just showing you that we got a sign. Not that exciting. What are we doing here? We got the paint matching and exterior work going on here. You can see where they redid some of the not Bondo. Stucco. Yep. You may, I don't know what that is. Oh, burned Japanese wood technique. Yes, we can try that. I don't know what that is, but we'll look it up.
Sounds cool.
New sign. This was a big hit. This is one of our big things we want to do, is really show the community and show this area that, we're new owners are in town, and we're looking to really make this place a better place to live for the community. And this picture on the left really shows that. We got the huge La Porta del Sol sign. We had a good friend of mine did the design work on it. Since this picture was taken, we have 2 lights that are going up that shine up to it so they can see it better from the road. And I think it's an 8-foot sign, so it doesn't really do it justice how big the sign is. But it's pretty big. And then we have that Franklin Red Rock. Yeah, the Franklin Red Rock throughout the whole property, because it had a bunch of just old, smaller rocks. We got this nice Franklin Red Rock, and then you can kind of see the bit of the parking lot. We had the parking lot repaved, resealed, restriped. So the whole property looks completely different than when we bought it for. If you looked at it now versus back in March, you would not think it's the same place. Yep, some pictures of some of I think these are level 2s. Just the color scheme that we're doing. So just gray, white trim, white cabinets, painted or resurfaced countertop if we can keep it. But we're not doing a whole lot to the interiors. We're not doing like full guts.
Except fully furnishing them.
Yes, digitally.
Yeah,
Virtually. Yep. So this is we're going into phase 2 of our reposition. You can kind of see where we're at on some of these projects. Still ongoing renovate units. We have 4 left, and you can see from last month where we took that stairs on the second one, and you can see where we stopped the project, and then all the way at the bottom on the left, you can see where we pushed it to. Somewhere in November. We're looking to start that back up again. And then the office conversion went from the move to the right a little bit, because that was a phase 3 project, which we probably would have started, Q1 next year. But the performance that we're having, we feel a lot more confident to start a project like that now. All right, I'm done. Who's going to introduce this one? Steve.
Am I doing this one? All right.
Yeah.
So some exciting news for the Tri-City Group. So this is a 22 unit that we actually put under contract here recently up in Michigan. This is to pair along with our 52 unit complex that we already have there very close by in Saginaw. So we're still doing due diligence on this one. Yeah, just like you mentioned, yeah. So the plan would be to add it to the existing 52 units to, obviously do some renovations, do some, some value add, and create basically a 74 unit portfolio that we could actually eventually, move on from, but go ahead and add this to that existing project and, just create a more enticing package to, a future investor whenever we're ready to exit.
Yeah. And it's important to note there, if you ever looked at, if you ever done multifamily, if you're in the space or looking at what other operators are doing, that there's like this weird, like slump area or like redheaded stepchild class of tenants or class of properties. And it usually falls between like the 30 and like 80 realm. And they're really good to capitalize on for like a small group of investors. But the reason they're in there is because if you have a single investor, maybe it's a high net worth individual, a doctor, a lawyer, something like that, and they just got a bunch of money they need to park somewhere. They don't want to put it in their stock portfolio. They can take down maybe a 10 or 20 unit by themselves, and then you get the other end of the spectrum where people are start syndicating, start doing JVs, where if you're doing a JV, usually you're doing with some kind of firm, an equity firm, and then you're bringing in the hustle. A normal JV structure, somebody brings money, you bring the sweat. But a lot of JVs, a lot of those equity firms, they don't touch anything under $1 million, under $5 million. And then the same thing with syndication. A lot of times if you're syndicating a deal, it doesn't make sense to do it unless you're in like the 100 unit realm, just because the upfront costs, the sunk costs are so high just to even start a syndication. Like, you're stroking a check for, checks for up to 30, 40 grand just in legal fees, inspections, and all this stuff and entity setups before you even close. And they're coming up with all that, and you're trying to spread that out across as many units as you can to make it work. And that's why you see a lot of syndicators don't really touch anything under, unless it's like an A class, right? But your normal C or B class property, they're not really touching anything under like 80 units, because it doesn't make sense. And then you're also throwing in there the on-site versus off-site management kind of throws a wrench in there as well. So most syndicators don't really touch anything under 100 units, under the 80, 100 unit thing. So you have this gap of properties. And that's where we're at right now with this. So we have a 52 unit property right in this town that we bought as a partnership. So exactly we're that group of people that could take down, a mid-sized multifamily without having to syndicate or do a JV structure. We just did a partnership structure and we were able to take it down. But now when we're looking forward, and remember, you're always looking at the exit, multiple exit strategies, making this, always thinking of who is going to be buying this property from you, and really starting to think about that as early on as possible. So you start building your business plan for the next person to make this, so appetizing for that next group of people that they don't have it's not really a question. They're going to be all over it. And one of the things was the 52 unit it's in that weird area where, it's too small for a syndication group to come in, definitely too small for a JV, but maybe too big for your small, group of people, partners that are looking at, they got a couple duplexes and they're looking to scale to something bigger. It might be too big for them. So one of our ways to combat that is snatch up this Bauer 22, and that's where this one fits in, is we can grab this 22, pretty attractive. I think we're under contract at 37 a door. So still a pretty good price, and wrap it up into the 52, make it a 74 unit. And now we're getting to that other end of the spectrum where we're going to start opening this deal up to possible syndicators, which is making our pool of buyers much, much bigger than if we were just trying to exit the 52 unit on its own. So that is one of the main drivers. The biggest driver for buying this 22 unit is because we're going to be adding it into the 74 and making the exit strategy for the whole portfolio that much stronger. I went into that way deeper than I planned. I just got excited. I'm sorry.